I guess my real question is, are we seeing a more permanent change, or is this a temporary blip in your judgment about how this is affecting the economy and the business world?
Well, I think, first of all, I think the damage is so unprecedented. As I think someone pointed out earlier, there have been 26 million unemployment claims in the last 5 weeks. The highest that we ever had, even in the Great Recession, was 700,000 in 1 week. So literally, this is almost 10 times what we would have had if we had taken the 5 highest weeks recorded in history. So the depth and the rapidity of this recession is staggering. At the same time, you have equally unprecedented reactions on the part of both the fiscal authorities globally and certainly here in the United States, and central banks, the monetary policy, and particularly our Fed. So what the market is really struggling with is, on the one hand, massive and unprecedented and rapid destruction in the economy, the real economy, which is going to affect corporate earnings. And on the other hand, trying to look through that and seeing, $2.5 trillion of fiscal stimulus with the 3 stimulus proposals or laws, and that is also 3 times the stimulus that we had in the Great Recession. And the monetary stimulus, the Fed started out buying $100 billion of treasuries and mortgage-backed securities a day, the most that they ever bought in a month during the Great Recession was $100 billion. So in one day, they're doing what they did in 1 month during the Great Recession. And so, ultimately, the fiscal policy and the monetary policy will mitigate the depth of the downturn, and it will precipitate a recovery. But we really just don't know how long that's going to take.
How long it's going to take, Ralph, but also how much of a recovery? I mean, there's lots of talks about V's and W's and J's and U's and things like that. Do you think a year, 2 years from now, we'll be close to where we were a year ago?
I think it's highly unlikely that the ramp upward will have the same slope as the ramp downward, and that's because, as I said, we're dropping off a cliff economically, and unfortunately, until the economy starts to reopen, the stimulus will basically be a tiding over. It's not really going to provide any stimulus for a recovery. You can't recover when so many of your small businesses are closed and when so many of your factories are closed. So it will hopefully help sustain people who are on unemployment and have lost their jobs, many of whom don't have much money to tide them from 1 week to the next. But in terms of getting the economy going again, I'm confident that our recovery will be dramatically slower than the recession, falling in the recession.
We're talking with Ralph Schlosstein, the head of Evercore. So in the meantime, even as this all unfolds around us, we have investors who are trying to make investment decisions. We have CEOs that you advise regularly trying to make their decisions about where their company goes. In this new world, do you have to take into account what the government, whether it's fiscal or monetary, is likely to do, even more than what the economy or an individual company is going to do?
Well, fiscal and monetary policy are an incredibly important input at this point in time. They're an important input for some companies in terms of survival. Do they have the access to cash to maintain their operations and to stay out of bankruptcy? and they're also important for companies who are in a stronger position, but who rely on the aggregate level of demand. And we have an economy which is 70% driven by the consumer. So without a growing economy and a strong consumer, even companies that are not as materially affected by the COVID-19 pandemic still have to look very carefully at economic policy and monetary policy.
Let's talk about your business a bit, Ralph. I mean, you had your earnings statement recently, and you already had done some retrenching for some softness in the marketplace. How is this going to affect Evercore?
Well, our biggest business is M&A, and M&A relies basically on a number of conditions to behave normally. It relies on a reasonably stable and well-valued stock market. It relies on high availability of credit. It relies on a reasonable judgment or sense of where the economy is going, and it relies on CEO confidence. The last three are not present right now. There's not readily available credit. We have no idea how the economy is going to evolve over the next 6 to 12 months. And as a consequence, CEO confidence is low. So our largest business, M&A, is clearly going to be quite negatively affected. The good news for us is that we've invested heavily in businesses that help where we can advise companies on their balance sheets, either in restructuring or advising them on debt or on equity capital raising. And so we're very busy, even though we're spread out among 1,800 offices around the globe. But the businesses that I just described aren't big enough for us to offset what will be a pretty significant decline in M&A activity for sure.
Ralph, if you look out, if you can, over the next 12, 18 months, do you expect that you will grow much more in things like advising on workouts, in restructurings, in dispositions, which one would think would grow to make up for at least a good part of the M&A? Do you have the opportunity to grow into that part of the business?
Yeah, those parts of our business are going more than flat out. And we're actually repurposing some of our bankers to become restructuring bankers and financing bankers because it's the same set of skills in many circumstances. So no question, those parts of our business are going flat out. They will grow very rapidly over the next 12 to 18 months. But as I said, they're not the same size as our M&A business. So overall, it's hard for them to make up for what will be an inevitable decline in M&A. But by the way, if we do get a reasonably rapid recovery and some settling down, it's quite possible that M&A activity will pick up again, 6 to 9 months from now. It will just require some visibility about the direction of the economy and settling down of markets before that happens. We still have lots of active dialogue with our clients because there are many things that they still want to do. It's just, everybody is reluctant, that old phrase, you don't want to catch a falling knife.
Do you expect that there will be as many bankers at Evercore and more broadly in investment banking 2 years from now as there was, again, 1 year ago?
I do, actually. My guess is 2 or 3 years from now we'll have more than we have today because we've, consistently taken market share. Our business model of independent advice without any conflicts with our clients hugely resonates with both large and small and medium-sized mid-cap companies. So even this last quarter, we once again gained market share in the advisory business. Our advisory revenues were up 10%, and the average of the 5 large U.S. firms, Goldman Sachs, J.P. Morgan, Morgan Stanley, B of A, and Citi, was down 13%. So we're taking share, and in order to continue to take share, our only input to our revenues is people, and so we will continue to grow.
And finally, Ralph, what about sectors? Do you see a difference in sectors among the companies you deal with? For example, right now, it seems like telecom is more needed than ever. Online is needed more than ever. Certainly, the tech sector seems to be rising. Do you see, as you deal with your clients, that there's more openness, more confidence, more opportunity there than perhaps in some other more traditional areas, such as manufacturing, materials, things like that?
Well, there are going to be a massive number of changes in our in lots of sectors as a result of this. Number one, we're all learning that we can be highly productive without being all in the same place. That has implications for center city real estate. It has implications for, in my view, family leave policies. Right. So in the service sectors, these are going to be very meaningful changes, in my view. In manufacturing, you're already seeing rethinking of supply chains. Do I really want to have one supplier for a critical part to my manufacturing process that comes from an area that could be affected by a pandemic? So I think there are going to be massive changes. Yep. Clearly, technology is inevitably going to be a continuing growing proportion of the S&P 500, in my view.
Right.